Welcome to Manifested Online Classes. My name is Joseph Kemani. So today we look on the revision of the paper which was tested in the sitting of April 2022. And I want we start with question number 2. So this question basically came from the topic of the group cash flow or the consolidated cash flow. So the question reads, first of all, we go through the question. It reads, the draft group financial statement relates to H Limited, a public limited company, and its investment companies. So we are given the group statement of financial position as at 31st October 2021 and 2020. So what we have there is one, the non-current asset, which include property, plant, and equipment. We have goodwill. We have intangible, that is other intangible asset, investment in associate, and then we have financial asset. Then from there we have the current asset, which include inventories, trade receivables, cash and cash equivalent, and then we have the total asset. Under equity, we have ordinary share capital revaluation surpluses, which you are told is for PPE and financial asset. And then we have the retained earnings attributable to group owners. And then we have the earnings attributable to NCI. From there we have the non-current liabilities, which include the long-term borrowing, deferred tax. And then we have the current liabilities, which include the trade payables, current tax, and then we have the total equity and liabilities. From there, we have the group statement of profit or loss and other comprehensive income for the year which ended 31st October 2021. So in that group statement of profit or loss, we have revenue, we have the cost of sales, we have the gross profit, we have distribution cost, admin expenses, operating profit, share of profit of associate or other operating or basically operating profit and other and income from associate, investment income, which you told include dividend income, finance cost, and then we have the profit before tax. We have the income tax expense, the profit for the year, and then we have other comprehensive income or OCI. We are given the fair value gain on financial asset, and then we are given the gain on evaluation of a property. Then from there we have now the additional information. In the additional information, we are given additional information note 1 up to note number 6 there. And from that particular information, what we are required to do is we prepare a consolidated statement of cash flows for H Group for the year, which ended 31st October 2021. And here we are required to use now the indirect method. Now, before we prepare this particular statement of cash flows, what we need to do definitely is we go through the additional information, we do some few workings, and then from there, finally, we prepare our statement of of cash flow. So let's go through the additional information as we do some few workings. Remember, we are doing question number 2 here. So the question or basically additional information note 1, we are told during the year which ended 31st October 2021, H Limited disposed of its entire 80% equity holding in S Limited for shillings 310 million in cash, and the carrying amount, or we are given the carrying amount of identifiable net asset of S Limited at the disposal date, which you are told comprised of PPE, that is property, plant, and equipment, inventories, receivables, cash, and cash equivalent. And then we have trade payables, we have the deferred tax. So what you're given there are the identifiable net asset of that subsidiary which was disposed. And then in the other paragraph, we are told the gain or loss on disposal of the subsidiary is included as part of the administrative expenses. And then you're told that the disposal of S Limited is not classified as a separate major line of business or geographical operation. So definitely, as far as that particular point is concerned, we are going to compute now the gain or loss on the disposal of that particular subsidiary. But before we do that, let's go through the last paragraph there. and you're told the investment in S Limited had been acquired several years ago at a consideration of 230 million when the fair value of identifiable net asset stood at 250 million. Now, what we need to do, first of all, let's compute the goodwill on acquisition of this particular subsidiary, because we need to have that particular goodwill in computing the gain or loss on what? On disposal. And I think there is some information still which are given in note 2. We are told the group policy is to measure the non-controlling interest of all subsidiaries at their proportionate share of the net asset at the date of acquisition. So if you're given such information, it is obvious that when computing the goodwill, you compute the goodwill using the partial goodwill what? Method. So therefore, let's start by computing the goodwill on acquisition of S Limited. So this will be our workings. This will be our workings. So working 1, we start by computing the goodwill on acquisition, the goodwill on acquisition of S Limited, Remember, S Limited here is a subsidiary which was disposed. And basically what you have said is that to compute this particular goodwill, we are applying which method? The partial goodwill method. So therefore, to compute this particular goodwill, first of all, we start by taking the cost of investment. The cost of investment. Now, when talk about the cost of investment, we are talking of that purchase consideration which was paid by the parent company in acquiring this subsidiary, and we have that in the last paragraph of note number 1, whereby we are told the consideration which was paid by the parent company was 230 million. So to this, what we need to do is to less the fair value of the net asset, which were acquired. Still in that last paragraph of note number 1, we are told that when this subsidiary was acquired, the fair value of its identifiable net asset stood at what? At 230. So therefore, not 230 but rather 250. So we take 250 million, and in this case, what you are told is or in paragraph 1, or yes, paragraph 1 of note 1, that the parent company had acquired 80% shareholding in this what? Subsidiary. So basically what that means is that the parent company did not acquire the entire net asset of 250 million, but acquired net assets which were equal to what? To 250 million. So therefore what we need to do is we compute, or basically we get 80% of 250 of 250 million, and this will give us 200 million. So what we need to do is we less that from our figure there of 230, and what you're going to get here is the goodwill on what? On acquisition. So therefore, let's have our goodwill here, which will be 30 million. So this is what? Is the goodwill on acquisition of this particular what? A subsidiary. So the reason why we need to have this particular figure here of 30 million, the goodwill on acquisition of S, is because we are going to use this figure in terms of computing the gain or loss on what? A disposal, which we then need to apply, or basically to use in preparing our statement of cash flow. Now, there is some other information which are given. If maybe just go to note number 3, we are told impairment test carried out on 31st October 2021, that is now the current year, showed that goodwill other than that arising on acquisition of S was impaired. So meaning that the goodwill on acquisition of other subsidiaries had impaired, except the goodwill on acquisition of what? Of S Limited. So basically what that means is that this particular goodwill here, the goodwill on acquisition of S Limited, had not impaired. Had not what? Impaired. Because if it had impaired, this goodwill had impaired, so what we need to do, we need to reduce it with the amount of impairment what? Loss. So I think that's what we have there. That's what we have computed that particular goodwill. And having computed that goodwill, I think we can now go back to note number 1, and we compute now the gain or loss on disposal of this particular what? Of this particular subsidiary, which is S Limited. So therefore, let's compute that particular gain or loss on the gain or the loss on disposal of this subsidiary. How do we compute this particular gain or loss on disposal? What we do is that we take the fair value of the consideration which was received. So in this case, when we talk about the fair value of consideration which was received, we are talking of the amount at which now our subsidiary was sold at. So, and that is information which we have in the first note, or additional information note 1, the first paragraph, whereby we are told that the parent company disposed the entire shareholding in S at an amount of how much? 310 million. 310 what? Million. So to this, ordinarily we add the fair value of any investment retained, of any investment which is retained. But in our case here, what we know is that this is a case of a full disposal. Is a case of full disposal. So meaning that there was no investment which was retained. So to this then we less two items. One, we less the parent company unimpaired goodwill. Parent company unimpaired parent company unimpaired goodwill, and basically that is what you have determined in our working one here. How much is that? 30 million. We less it there, 30 million. And then 2, we less what if are is the net asset, the net assets, net asset at date of disposal, net asset at date of disposal, net asset at the date of disposal. And basically this is what we have in note number 1. In note number 1, we are told that the carrying amount of identifiable net asset of S Limited at the date of disposal amounted to how much? Amounted to 300 million. Amounted to 300 million. So therefore what we do is that we take remember here the parent company did not have 100% shareholding in that subsidiary. The parent company had 80%. So meaning that the net asset which were disposed then will be taken to be what? To be 80% of 300 million. So therefore, let's determine 80% of 300 million. And this will give us what? This will give us 240. This will give us 240 million. So what we need to do now is we less all those figures, or basically less the two figures from 310 million, so that we do what? We determine now whether we have a gain or a loss on what? Disposal. So we have 310 minus what? Minus 30 minus 240 minus 240, and that will give us what? That will give us 40 million. So 40 million is our what? Which is basically a positive figure here, which is a positive figure here. This is what? This is a gain on disposal. Is a gain on what? Disposal. So the reason why we say it is a gain is because this is what? Is a positive figure. But if we got a negative figure there, then that would be what? Would be a loss. Would be a loss on disposal. So I think we are through with that particular note there, but definitely we are going to come back to that note specifically when dealing with the issues to do with the PP, the changes in working capital and so on. So from there we have dealt with note number 2, which was giving us the policy of determining goodwill. Note 3 was about what? Okay, we can I think go through note 3. We are told impairment test carried out on 31st October 2021 showed that the goodwill other than that arising on acquisition of S Limited was impaired. And also we are told other intangible assets were impaired. I think in this case we can determine 2 items as far as note number 3 is concerned. We determine the impairment loss of goodwill and also the impairment loss of what if is intangible what? Asset. These are a number of items we need to take into account when computing the cash flow from the operating what? Activity. So let's have working 3 here. Working 3. So, and we determine the impairment loss on goodwill. How do we determine that impairment loss on goodwill for the current year? So definitely we do that in terms of preparing the account which is called the Goodwill Account. The Goodwill what? account. So therefore, let's prepare the Goodwill account. The Goodwill account. This particular account, we prepare it basically to determine what? To determine now the impairment loss. Impairment loss on what? On Goodwill. On Goodwill. And also we are going to prepare another account here, which is the intangible asset account. The intangible asset account. So we need to have those two accounts here. So how do we prepare this account? So we start by recording the opening balance. Remember, goodwill is an asset, so mean that always this account has a debit balance. So the goodwill at the start of the year was how much? It was 1080. It was 1080. And then we also have the goodwill at the end of the year. At the end of the year, how much is that? Is 945. 945. And then from there, what else do we have? The other item which we need to take into account here is this goodwill relating to this subsidiary which was disposed, because this goodwill is part of the opening goodwill. It's part of the opening goodwill, and because the subsidiary has been disposed, so what we need to do is to basically remove that figure from here. How do we do that? How do we remove 30 million from this figure? We credit this account. So we credit this account with the goodwill of the subsidiary which was disposed. With the subsidiary disposed, which was disposed, its goodwill was how much? Was 30. Was what? 30 million. So in our case, I don't think we have anything else which will be affecting this particular account, because maybe the other item which we can take into account here is any goodwill in respect to a subsidiary which was acquired. So in our case, we know that there was no subsidiary which was acquired in course of the year. Now, the balancing figure, which now will be on the credit side of this particular account, automatically it will be what? It will be the impairment loss. That's what we need. So we take 1080 minus 30 minus 945. 945. So we get a balancing figure here of how much? Of 105. Now this 105 is what? Is the impairment loss. Now this impairment loss of 105, it is the amount now which was taken to the income statement as an expense, but definitely what we know is that this impairment loss is a non-cash item. Is a non-cash what? Item. So therefore what we are going to do, we are going to add that to our profit, because that item had been deducted, but definitely it is a non-cash item. So then from there, let's also deal with other intangible assets. Remember the information which are given note 3. Goodwill was impaired and other intangible assets were also impaired. So therefore, we need to prepare this other account, which is called what? The other intangible asset. So this will be our working for other intangible asset. And I think for the other intangible asset, without necessarily preparing this account, I don't think we need to prepare this account, because these do not in fact have so many items. We can just compute that directly. We can just compute that directly without necessarily preparing that account. So meaning that here we determine the impairment loss. Impairment loss on other intangible asset. So this is quite straightforward, because we just need to compare the opening balance and the closing what? Balance. The opening balance was 1800 and the closing balance was 1350. So therefore here you can see we have what? We have a decrease in the value of intangible asset. A decrease of what? 450. Now this decrease in the value for intangible asset, this is the loss of value of intangible asset. Generally, this we refer to it as amortization, but here is just referred to it, or the examiner referred to that as impairment loss, which is just one and the same thing. Yes, so we are through with that note 3. Let's move to note number 4. We are told H Limited disposed of a plant with a carrying amount of 440 million for a cash proceeds of 560. The gain on disposal is included as part of admin, expenses. So what we need to do, let's also determine what we determine now the gain or loss on the disposal of that subsidiary. But in our case, I think we are told there was there was a gain, because if you to compare the carrying amount and the sales proceeds, you can see that the sales proceeds is more. So the gain on disposal, and this is the gain on disposal of of the plant. The gain on disposal of the plant. On the plant, so how much is that? We take now the sales profit. Our plant was sold at 560. It had a carrying amount of how much? It had a carrying amount of 440. So the difference here, which is 120 million, this one is a gain on disposal, and basically you're told that this was included as part of admin. We also know that a gain or a loss on disposal of an asset is an non-cash item, and therefore we are going to treat that in the same way, just like the loss on the impairment loss on intangible asset. We are going to do what? We are going to add this one back to our profit because it was deducted, but we know is a non-cash item. So we are through with that. And then note 4, still we are given depreciation charged to profit or loss during the year, which was 260. Now this particular depreciation equally is a non-cash item. So therefore, we are going to adjust that in our profit. So then in note number 5, we are told the following schedule relates to financial asset at fair value through other comprehensive income held by H Limited. So that information you're told it relates to financial asset. Financial asset, we have to remember that this is an investment in shares, and when talk about now the financial asset at fair value through profit and loss, this whereby the company invests in shares and the company intend to retain ownership of such shares for a long period of time. So generally, this should be accounted for by the company as a non-current asset. We are given now the breakdown. So we are told the financial asset at the start of the year 1620, and then rest carrying amount of financial asset disposed of. So there are some financial assets which were disposed of, and they had a value of 235. The company equally acquired other financial assets, and also we are told there was a fair value gain. So this fair value gain of 35, this one is accounted for as part of other comprehensive income. And then there below we are told the sales proceeds of the financial asset was 360, and then you're told the profit on the sale of financial asset is included as part of investment income. I think equally there what we need to do is we need to determine the profit on the sale of those financial assets. Profit on a sale of a financial asset. So this is also quite simple because we just need to compare the amount at which now the financial asset was sold at. That is now what you're given in in the last paragraph. In the last paragraph of note number 5, we are told the financial asset was sold at how much? 360 million, but we are told they had a carrying amount of how much? Of 235 million. So the difference here will now be what? Will now be a profit. Will be a profit. So we take 360 minus 235. This will give us how much? This will give us 125 million. And this 125 million, which is a profit on the sale of a financial asset, we are told in the last paragraph of note 5 that this was included as part of investment income. But generally, also what we know is that this is This is a non-cash item. It's a non-cash item. So therefore, what we are going to do, we are going to less it from profit, simply because this was accounted for as an income, but it is a non-cash item. So finally, we are told in note 6, the profit for the year attributable to NCI was 390. So this information, you're going to use it later on when computing now the dividend paid to minority shareholders or the dividend paid to NCI. So, and I think from that, we can now proceed and prepare what the examiner was requiring here. The examiner was requiring we prepare now a statement of cash flow, a group statement of cash flow, and we use which method? The indirect method. So the examiner had specified which method to use here. So let's do that. Do we have, okay, we need first of all to have the title. The name of the group is H Limited Group. So we need to have that title here. So H Limited, or just we say H Group. H Group, this is what? This is a consolidated statement of cash flows. Statement of cash flows. Which is for the year which ended 31st October of 2021. And remember here we are using which method? We are using the indirect what? Method. We are using the indirect method here. We are using the indirect method. Now, when preparing a statement of cash flow, generally we start with by determining the net cash flow from operating activities. And then from there we proceed, we determine the net cash flow from investing activities, and finally the cash flow from financing what? Activities. So therefore what we start with here is by getting cash flows from operating activities. From operating activities, we need to have at least two columns here. Two columns. I think we can have these in short. So our figures need to be, or basically are in million of what? Are in million of shillings. So therefore, that's what we start with here. Cash flow from the operating activities. We have two columns here. Yes, that's what we should have. Now, what do we start with? Here? Always, anytime you choose the indirect method, you start with the profit before tax, and then you need to adjust that profit with a number of items. Actually, 3 items: 1, non-cash items; 2, any financing or investing activity item added or deducted in arriving at that profit; and 3, changes in working what? Capital. So therefore, what we start with here is the profit before tax. So the profit before tax automatically is something you get from the income statement of the company. How much is the profit before tax? The profit before tax is 1675. And then I've said that we need to adjust this profit with a number of items, or we need to make a number of adjustment to our profit. We have 3 categories of items which we adjust to that profit. Any non-cash item added or deducted in arriving at that profit. Number 2, investing and financing activities items, and also changes in working capital. So I think we can start with what we have. Okay, before you go to the additional information, there are some free marks which you pick from the income statement, from the items included in the income statement. There are always some free marks there. Above the profit before tax, we have a number of items. One of it is finance cost. Now, this finance cost, in other terms, this is what we refer to as interest. This figure of 100, you can see it has already been deducted in arriving at that profit, but this is not an operating activity. So basically, an operating expense, that is. So what we know is that finance cost is the interest or the cost incurred by the company as a result of raising finance. This is not an operating expense. So take into account it has been deducted here. We need to add it back. The other item we also need to take into account is what? Is the investment income. The investment income, and you're told that this included dividend income. This dividend income automatically is from the financial asset. Remember, we under the non-current asset, this company had some financial asset. This financial asset, remember, you have said, is investment in shares. As a result of the company having invested in shares, it is obvious that the company receives some income which is in form of what? Dividend. So therefore, the figure which you are given there of what? Of the dividend income, which you are not given. But also, if you can be able to remember, there is some information which you are given in note number what? Note number note number 6, note number 5, the last paragraph there. Note 5, the last paragraph, you're told that the sales proceeds of the financial asset was 360. It referred to this. The profit on the sale of financial asset is included in the investment income. So this particular figure here, that is the profit on the sale of financial asset, the amount of 125. This one is included here. So basically what that means is that this investment income, which is in the income statement, it comprises those two items. It comprises the profit, and this profit, we know that this is a non-cash item. What about the dividend income? Dividend income in this case will be 270 minus 125, and this will give us 145. So this is the dividend what? Incomes. But in our case, what we need to do, we need to take into account the total amount here, the dividend income. Dividend income, the reason why we need to less that from our profit here is because this is not an income from operating activities. On the other hand, the profit, this profit on the sale of financial asset is a non-cash item. Is a non-cash what? Item. So you may decide to split all. You have then the total amount here, 270, which you less from our profit there. So let's go back to the income statement. We are trying to pick some of the items on the face of the income statement. So above the investment income, we have operating profit, okay? And then above that, we have something called the share of associate profit. Now, this share of associate profit equally this is a non-cash item, and also this is not an income from operating activities, which has already been added there. What do we need to do? We need to less it. And then above that, we have operating profit and so on. So therefore, you can see that from the face of the income statement, the number of free marks you get there. You get what? You get there. Now from that, or basically from there, we can now proceed and we go back to our workings here. So which items do we pick? Which items do we pick here? Maybe from this working 2, we have this gain on the gain on disposal of subsidiary. Gain on disposal of subsidiary, how much is that? Is 40, and basically we say that this gain is also a non-cash item. Is also a non-cash what? Item. So what we need to do is basically to do what? To less it, because it has already been added there. So, and it's a non-cash item, we do what? We less it. So what else do we have? We also have this impairment loss. Impairment loss on goodwill. Impairment loss on goodwill, how much is that? Is 105. So which is an expenditure. In arriving at this, it has been deducted. What do we need to do? We add it back. So we also have this impairment loss on intangible asset. On intangible asset, which is 450. Still, it was deducted in arriving at our profit there. What do we need to do? We need to add it back. And then we also have this gain on disposal. Gain on disposal of plant. How much is that? It is 120. So this gain, because this is an income, in arriving at this particular profit here, it has been added. And because it's a non-cash item, what do we need to do? We need to less it there. We need to less it there. I think those are some of the items which we have from the additional information. Maybe we can just go through the notes. We see whether we have been able to pick all the items. We are through with note 1 about, we have dealt with that gain. Note 2 is about goodwill. Note 3, Note 3 is about impairment loss of goodwill intangible asset. Note 4, okay, we have dealt with this gain here. And also note 4, there is something we need to pick there, and that is depreciation. Depreciation on property, plant, and equipment. How much is that? Is 260. Still, this is a non-cash item. In arriving at this figure, it has already been deducted. We add it back because it's a non-cash item. So then from there we have note 5. I think you have dealt with that. And also note 6. Yes. So I think those are some of the items we need to adjust now in our profit there. And what we get here is something known as the cash flow before changes in working what? Capital. So let's get our net figure there. 1675 plus 100 minus 270 minus 90 minus 40 plus 105 plus 450 minus 120 plus 260. 260. Yes, that will give us 2070. This one, we refer to it as cash flow. Cash flow before changes in working capital. Before changes in working capital. Before changes in working what? Capital. And then from there, what we do here is we consider something called the changes in working capital. We consider changes in working capital. Changes in working capital. Now, working capital here, we consider basically a number of items. We consider various items of working capital. Actually, 3 items: inventory, receivables, and also payables. Those are the 3 items which we consider here. So we can just highlight them here. So where do we get those items? You go back to the statement of financial position, specifically at the current asset and also non-current, at the current asset and also current liabilities. You pick 3 items. 3 items. 2 items of current asset, inventory, and receivables, and then at the current liabilities, you pick payables. So, and what you just need to do is then you determine, was there an increase or decrease as far as those 3 items are concerned. So we then have the trade receivables. So then we go to where we have current liabilities. We take into account trade payables. Trade payables. So what we need to do here is to determine whether there was increase or decrease as far as these 3 items are concerned. So how do we do that? So first of all, we take the opening balances of these 3 items. We take the opening balances. For example, the opening balance for inventory was 1710. So actually these always are free marks in an exam. So 1110 for receivables, it was 1620. What about payables? What about payables at the start? Payables at the start were 2920. Now, on the other hand, you also need to check whether during the current year there was a subsidiary which was acquired or disposed. In our case, we know that there was a disposal of a subsidiary. Remember, the parent company disposed what? A subsidiary. And because that subsidiary had a number of assets, or basically the asset of that subsidiary were part of the group asset, the asset and liabilities of that subsidiary were part of the asset and liabilities of the group. So we need to come and we list here the asset and liabilities of that what? Subsidiary. And basically that is the information we have in note 1. In note 1, we are given the asset of the subsidiary which was disposed. So we check, was that subsidiary having inventory? Yes. So the inventory of that subsidiary was 90. And because that inventory was part of this opening balance, and the subsidiary has been sold, what do we need to do? We need to list that here. We need to do the same to receivables. It had receivables of 50. it had payables of 60. Of what? Of 60. So basically what we get, we have to compare that with the closing balance. We compare that with the closing what? Balance. Whatever we get there, we compare it with the closing what? Balance. So how much was the inventory at the end of the year? 1395. Receivables was 1125. 25, and then payables at the end of the year was how much? Was 21 what? 15, 21.15. Yes, so what we need to do is to determine whether there was an increase or decrease. We start with the inventory. Inventory, we take the balance at the start, which is 1710, but first of all, we less what? The inventory for the subsidiary which was disposed, which is 90. So that will give us 1620. So basically that 1620 should be the inventory which is there at the end of the year. But the inventory at the end of the year is how much? 1395. So basically what that means is that then we have a decrease. We have a decrease in the inventory. So anytime the inventory reduces is because the group sold. So it's a cash inflow. Generally, the rule is that any increase in a current asset is a cash outflow, decrease is a cash what? Inflow. The reverse is true when it comes to liability. So we do the same for receivables, 1620 minus 50. That will give us 1570. And then we compare that with what is there at the end of the year. That basically means that we have a decrease of 445. 445. So this increase, we have said, maybe you can just take that again. We have said we have 1620 minus 50, which is 1570. We compare that with the receivables at the end. The receivables at the end, meaning that we have a decrease. We have a decrease of A decrease of 445. And this particular decrease in what? In receivables is a cash inflow. Is a cash inflow because it means that the debtors paid. The debtors paid. I think as far as the inventories are concerned, we are also correct. So maybe you can just take that for inventory again. So for inventory still we have a decrease, yes, which is okay. A decrease means that we sold. So if we sold, we got cash. It's a cash inflow. And finally, what about payables? 2920 minus 60. That will give us 2860. We compare that with what is there at the end of the year, 2115, which is a decrease. The reason why the payables decreases is because the suppliers have been paid. Remember, this is the amount of money which is supposed to be paid to the suppliers. So meaning that if the suppliers have been paid, automatically what is that? That is a cash outflow. Is a cash what? Outflow. Yes, so those are basically I've said are 3 marks. And finally here, we need to come and we list 2 items. We need to come here and we list 2 items. One of it is tax paid, and the other one is what we refer as the interest, or the finance cost, which was paid for. The tax. This one we have to prepare the tax account because for tax ordinary do have a number of items. So we have to prepare the tax account. So we can prepare that account here. The tax account. How do we prepare this particular account? We need to take a number of items. One, you go to where we have the current liabilities and non-current liabilities. You check whether there was deferred tax and also the current what? Tax. First of all, under the non-current liabilities, we have deferred tax. And also under current liabilities, we have current tax, of which those 2 items are items of liabilities. So what we know is that liabilities do have credit balance. So first of all, we start by taking deferred tax, DT. Deferred tax at the start of the year, DT, which was 880. What about current tax? CT, stand for current tax. Under the current liabilities, how much is that? Is 1240. And then we also need to do the same at the end of the year. We need to do the same at the end of the year. So we take the balances at the end of the year for DT, deferred tax, CT, current tax. Deferred tax at the end of the year is 315. Current tax is what? Is 440. 440. And then from after recording those two items, we go back to the income statement. We take into account the tax for the year. The income tax for the year in the income statement. The income tax for the year is supposed to be credited in this account simply because that increases the tax liability of the company. So how much is that? 415. So the other item we also need to check is whether the subsidiary which was disposed in Note 1, that subsidiary had any tax liability. Was it having any tax liability? Yes. Yes. So the tax liability it had was 20, of which that tax liability was part of the opening. Part of the opening tax what? Liability of the group. And because now the subsidiary has been disposed, then that subsidiary has been disposed with its asset and also what? Liability. So we need to remove that from the opening balance by debiting this account with an amount of 20. So I think those are items we need to take into account. The tax in the income statement, the tax liability for the subsidiary disposed, the opening and closing balance for the deferred and current tax. So from there we need to determine the balancing figure here, which now we represent the tax paid. The tax paid, which now will be the balancing figure on the debit side. So we take 880 plus 1240 plus 415 minus 20 minus 315 minus 440. So that will give us 1760. 1760. Maybe you can just confirm that that is correct. 880 plus 1240 plus 415 minus 20 minus 315 minus 440. Yes, that will give us 1760. So that 1760 is what? Is the tax which was paid here. 1760, and tax paid, this is a cash outflow. Whenever the company pay tax, we know this is a cash outflow. Then what about the interest? Interest, this is another name for the finance cost, which we have in the income statement. So the finance cost in the income statement is 100, and that is the finance cost for the year. But now for you to determine the amount of finance cost or the interest which was paid, you need to go to where we have current liabilities and you check. Was there any accrued interest? Do we have any accrued interest at the current liabilities? No. It is obvious that the interest for the year or the finance cost for the year, which is 100, this is the amount which was paid. So we come and we less it here. Remember that is still what? A cash outflow. And what we shall get here is the net cash flow now from the operating activity. So we need to work out all this, or basically from here. So we take 2070 plus 225 plus 445 minus 745 minus 1760 plus 445 minus 745 minus 1760 minus 100, and that will give us 135. That will give us 135. What is this 135? This is the net cash flows from operating activities. Net cash flows from operating activities. So having that now, what we need to do is we proceed and we determine the cash flow from what? From the investing activities, cash flows from investing activities, investing activities. Now, investing activities are those particular activities which relate now to acquisition and also the disposal of asset. Acquisition and the disposal of assets. That is now what we need to consider here. Assets which were acquired, the assets now which were disposed, and so on. So that what we need to have here. So what do we have? So let's start with additional information. We go through the additional information. In note 1, we have a disposal of a subsidiary. Disposal of a subsidiary. Now, as far as the disposal of the subsidiary is concerned, what do we take into account here? We take into account the amount of money received from the sale of the subsidiary, which is in additional information note 1, which is 310, which is a cash inflow. But to this, what we do, we know that the parent company received 310, but at the same time, it sold or it disposed a subsidiary which had a cash of how much? 30. So meaning that the net cash inflow was 10,280. Was 10,2 what? 280. That's what we have there. In note in note 1, we don't have anything else here. In note 2, note 3 is about goodwill impairment. And then note 4, we have the disposal. We have the disposal of plant. Whenever the company sell an asset, what you consider here is the sales proceeds of 560, which is a cash inflow. We also have depreciation. We don't consider that here. Then from there we go to note 5. In note 5, we have a number of items we need to take into account here. One, there was a disposal of a financial asset. There was disposal of a financial asset. The financial asset which was disposed at 360, which is a cash inflow. We need to take into account that here. And also in the same point, we are told there was purchase. There was a purchase of what? Financial asset. And the financial asset which were purchased, they had a cost of 515, which is now a cash what? Outflow. Which is a cash outflow. A cash outflow. Yes, that's what we have here. Then note 6 is about the profit, but from there are a number of items we need to determine here, which are not given in the additional information. So one of it, we need to determine what if far as the dividend received from associate. Dividend received from associate. This is quite straightforward in terms of how we compute this. So we are supposed to take 2 items. One, we take into account the investment in associate at the start of the year, which is a component of a non-current asset. We go to the statement of financial position at a non-current asset. Investment in associate at the start was 810. And then to this, we add something called the share of associate profit in the income statement. In the income statement, the share of associate profit is 90. So we add the 2, and then we less the investment in associate at the end of the year, which is 720. So this will give us 900. 900 minus this one. Will that be 180? 180, we can't confirm that. Let's just confirm that. We have 810 plus 90 minus 720. Yes, which is 180. And basically, these are cash what? Inflow. These are the dividends with the parent company received from what? Received from the associate. What else do we need to take into account here? So we can go to where we have a current, non-current asset. We check whether we have dealt with all those items. So I think first of all, we have dealt with the financial asset. We have also dealt with investment in associate. We have dealt with the other intangible asset. And we have dealt with goodwill. Now something which we have not dealt with is the PPE. So basically, we need to determine whether there were some PPE which were acquired. I think we can just prepare that account here, or we can just have that summary here for PPE. For PPE, the reason why we need to have that summary here is to determine whether were there some PPE which were acquired. So the PPE at the start they had a value of 41.85. And then to this, what do we need to add? We need to add a number of items which increases the value of PPE. One of it is the revaluation gain. If you go to the income statement, specifically under other comprehensive income down there, you'll be able to see there was gain on the revaluation of property, which was 65. That automatically increases the PPE at the stand. The other item which increases the value of PPE is the purchase. This is now what we are not given. The examiner will not give you the PPE which were acquired. So and that basically what we shall need, or we need to determine whether there was some PPE which were acquired. Also, in the event there was a subsidiary which was acquired, in which case we don't have one, you add the PPE of the subsidiary acquired. And then to this, we need to list a number of items. One, we need to list the PPE which were disposed. We have that in note number, In note number 4, there was a plant which was disposed which had a carrying amount of 440. And to this, we also need to list the depreciation for the year, which we have still in note 4 of 260. To this, we also need to list the PPE of the subsidiary which was disposed. We have that in note number 1, which is 210. Yes, and basically this now will give us what? Will give us the PPE balance at the end of the year. Which we have still in the statement of financial position as 4275. So basically what we need to do here is quickly determine whether there were some PPE which were purchased, which now will be part of this. So we take 4185 plus 65 minus 440 minus 260 minus 210 minus 210. Yes, is that giving us this one? No. So there is a difference of how much? 4275. So that difference, which is 935, this now represent what? This represent now the PPE which were acquired. So there was acquisition of property, plant, and what? Equipment which had a value or which had a cost of what? 935, which is automatically a cash what? A cash outflow. Is there anything else we need to take into account here? I think we have dealt with all items of non-current asset, PP, goodwill, other intangible investment, financial asset. Do we have anything else? I don't think so. So what we need to do here is we get the net amount. Here. So we have 260 plus 560 plus 360 minus 515 minus that is plus 180 minus 935. Yes, so that will give us a net cash outflow. Of what? Of 70. Yes. So I think now we can do away with this one. And finally, what we need to do is to determine the cash flow from financing. Activities. So this is the last section of our cash flow. Cash flow from what? Financing activities. Financing activities are basically those particular activities that are taken by the company in course of the year and which affect the size and composition of the company's capital structure. In fact, the items now which we include here, all of them, we get them from equity section of the statement of financial position and the non-current liability section. So therefore what we do, we go to where we have the equity section, and the first item which we have there is the ordinary share capital. We can see that the ordinary share capital increased from 6,000 to 8,000. So the reason why the ordinary share capital of the company increases 2,000. So then from there we need to proceed to the other item, which is below ordinary share capital, which is revaluation surplus. Now this revaluation surplus, this is a non-cash item. We don't consider it here. Anytime the assets have been revalued, that is a non-cash item. Below that we have the retained earnings. Now the retained earnings, we use that in terms of computing something called dividends paid by the parent. Dividends paid by the parent company. Paid by the parent company. In terms of how we compute these dividends paid by the parent company, is quite simple, because what we do is that we take the retained earnings at the start of the year, which is the 35, and then to this what we do is that we add the profit for the year attributable to the parent. The profit for the year attributable to the parent, are we given that profit for the year attributable to the parent? No. So, but what you are given in the income statement, we are given the profit for the year for the group. How much is that? 1260. But also in the last note, note 6, we are given the profit attributable to NCI. So what we need to do from this figure of 1260, we need to less the profit attributable to NCI, such that we shall be left with what? The profit attributable to the parent. That's what we add to the retained earnings at the end. And then we less the retained earnings at the end. Okay, this is the retained earnings at the start. We less the retained earnings at the end of the year, which is 3715. And basically what we shall get there are the dividends paid by what? By the parent company. By the parent company. I think we shall compute that. And then below that, there is something we have there, and that is equity attributable to NCI. This, in other terms, we just refer to it as NCI. That one, we also use it in terms of computing the dividends paid to NCI. Dividends paid to what? To NCI. How do we compute that? Also very, very simple. So we take the NCI at the start. NCI at the start is 585. To this we add the NCI share of profit. How much is that? Is 390, which we have in the last note. And then we check whether in course of there was a subsidiary which was acquired or subsidiary which was disposed. In our case, we have a subsidiary which was disposed. And because the minority shareholders' share of the net asset in that subsidiary is part of this, and the subsidiary was disposed, we need to less the NCI share of the net asset from the subsidiary which was disposed. So the net asset of that subsidiary was 300, but the NCI share will be 20%. So we take that, the NCI to the start plus the share of profit minus the share of net asset in the subsidiary disposed minus the NCI at the end of the year. The NCI at the end of the year is what? Is 810. 810. Now that will give us the dividends now which were paid to NCI, to minority shareholders. So let's first of all start by computing this. 3135 plus 1260 minus 390 minus 3715. That will give us 290. So these are the dividends paid by the parent. Dividends paid by the parent is a cash outflow. And then dividends paid to NCI, 585 plus 390 minus, this will give us what? That should give us 60 minus 60 minus 810. That will give us one what? 105. These are the dividends paid to who? To NCI. Dividends paid to NCI. That's how we determine that. I hope you can see where we have gotten all those items under the equity section. Finally, we got where we have non-current liabilities. Still in the statement of financial position, there we only have two items: long-term borrowing and deferred tax. Deferred tax, we have dealt with that in terms of computing the tax paid. So we are only considering one item. And which is that item? Long-term borrowing. Now the long-term borrowing, you can see there was basically a decrease from 610 to 235. But also it is advisable you go to the subsidiary which was disposed. You check, was that subsidiary having a long-term borrowing? No, it didn't have. So meaning that decrease in long-term borrowing is a repayment, because this is equivalent to a loan. repayment of long-term borrowing. Long-term borrowing. So we have a decrease of what? A decrease from 610 to 235. 610 minus 235. The reason why the loan will increase is because there was a repayment, 375, which is a cash what? Outflow. Do we have anything else to be included here? No. So therefore, what we need to do is we get the net. We get the net, which will be 2,000 minus 290 minus 105 minus 375 minus 375. So that will give us what? Will give us 12, that which is a positive. So and then now from there, what do we need to do? We need to get something called the net changes. The net changes in cash and cash equivalent. The net changes in cash and cash equivalent. So how do we arrive at that figure? We arrive at that figure by adding the net cash flow from operating, from financing, and also from what? From investing. Okay, there is something we need to include here before we add. I think there is something we omitted there because there were dividends which were received. Other than these dividends which were received from the associate, if we go back to the income statement, specifically where we have investment income, those investment income, we are told, they include dividend income. Dividend income, this is a form of an investment income and should be included here. So we omitted that here. We need to include it here. And we can be able to determine those dividends which were received. Let's just put that here. Other than these dividends which were received from associate, we have the dividends which were received in respect to financial what? Asset. Now, those dividends, we are told they were included as part of investment income in the income statement. Now, that investment income is how much? Is 270, but we know or what we are told in note number 5 is that this profit, the last paragraph of note 5, this profit on the sale of financial asset 125, it was part of this investment income of 270. So that 270 comprised of two components. This gain of 125 and the dividend received. So to get the dividend received, we take 270 minus the profit on the sale of financial asset, and that will give us 145, which is a cash inflow, inflow. So what we need to do is basically to correct this figure, and if we take 145 minus 70, so automatically that will give us positive 75, and having that now, we can now proceed and we finalize by getting now the net changes in cash and cash equivalent. We take 135 plus 75 plus 1230 which will give us a net changes in cash and cash equivalent of what? 1440. And then to this, what do we add? We add the cash and cash equivalent, cash and cash equivalent at the start, balance brought down. This, we get it from where we have the current asset. Where we have the current asset, do we have what? Yes, in fact, we are given the cash and cash equivalent at the start, which is 2745. So we add the two. What we shall get here is known as a cash and cash equivalent balance carried down. And the cash and cash equivalent balance carried down is 4185. It is obvious after adding the two, we should get the same figure. 1440 plus 2745. That will give us what? That will give us the same figure of 4185. Yes. So that is it. That what was expected in that particular question. it was a quite straightforward question from the topic of the group cash flows. So that brings us to the end of that question. We take a short break, then we come back, we look on the other question.